there's been a series of failed projects that we've seen in Canada and around the world. But if you compile the gold projects that have been built, or the precious metals, I should say, since 2010, around a third of them have failed, gone to bankruptcy, or at least stopped production. Another third is producing significantly less in terms of cash flow or ounces of production. And it's really hard to define what went wrong in these situations. If a plane crashes, the FAA does a significant investigation, root cause analysis, and we get to the bones of what occurred. And in these cases, we rarely see what really occurred. You know, I get the chance to sometimes look at these projects just before their imminent death, or just after, to try to see if we can't help them. And oftentimes it's a confluence of different factors, but those factors all usually come back to the human judgment and the errors in the human judgment to apply the assumptions that went into the initial studies. So that's what we're going to talk about today. And you might be surprised that a third of the gold projects have failed. Some of these are very small things that we've already forgotten and moved on from. But those have major impacts on the people that in those communities around there. Also, you know, the contractors may not have gotten paid. Investors lost their money in equity or the debt. And so they have an impact on the future projects, and it's really important for us to get a better understanding of what went wrong. So I'm a geologist. You're going to see that it's quite cynical in parts, this presentation. And I worked previously as a consultant, so I'm going to talk about the relationship between consultants and clients. I understand, I've been in that situation, so please don't take it personally. I want to talk about the real important things, and you might find it's a little bit negative, but hopefully we'll get through it very nicely here. So cognitive biases are essentially systematic errors in thinking that occur when people are processing and interpreting information. So we're all primates. We came down from the trees in the savannah, and our brains are still mostly wired in that frame of reference. And the way we navigate through life is through a series of shortcuts to try to live as well as we can without causing too much disruption and hardship. And there's a whole series of these cognitive biases. When I started getting interested in this, went on Wikipedia, and there's dozens and dozens of them. So I've just selected a few that are most interesting or relevant to what we're going to talk about. The first one we're going to talk about is the IKEA effect. So essentially, this is if you invest time or energy in a project or product, you tend to value it more than if you've bought it. So the Allen key spinning actually creates more value for that table rather than if you bought it somewhere else. And we see this in companies, especially in the junior exploration market, where you have a concept, you're going to test this exploration target, and you create this whole personalized company with logos and branding and marketing and build a team. And it's really hard to go back and say, like, this thing doesn't work, let's stop it and try something else. And it relates to the sunk cost fallacy, where once you've spent a bunch of energy, you stop looking backwards and you only look forward to the future of what's going on. Authority bias is something that's important, and this is going back to the client-consultant relationship. So it's a tendency to attribute greater weight to the opinion of an authority figure. So this is a photograph of Flight 052 Avianca that crashed a few kilometers away from the airstrip at JFK Airport. The plane was structurally sound. The pilots were okay. The main reason this flight crashed was the main pilot was a little bit out of touch, wasn't paying attention. The co-pilot realized the emergency of the situation. They were running out low on fuel, and they kept circling. And the way that the co-pilot was communicating with the main pilot and with ground control was very timid, very not pushing, and it was obvious that he felt like he was not being valued, or he was not in a position to impose his view. So essentially, they ran out of fuel. It was too late by the time they convinced the air traffic controller, which was a typical New York strong, like, this is the next thing, stay at your elevation, these are the instructions. But it was too late, and there was many lives lost here. So we'll talk a little bit more about how this applies to mining in the subsequent slides here. Commitment bias is a tendency to keep to commitments to avoid reputational damage. So one good example here is if you have starting a feasibility study, you hire the 5 consulting companies, you have 20 or so qualified people that are working on the project, and the people that are actually going to sign off and take responsibility for some of the aspects may not know what is the background, may not know, how much data is available and how representative it is. So if we take, for example, earthworks, which is where we see lots of CapEx blowouts in the industry, that aspect is something that is sort of an afterthought in many cases. So the QP responsible for costing that and figuring out the volumes could make a recommendation like, listen, I need 20 more drill holes. It's going to push out the schedule another 4 months. I'm sorry, but this is what's required to know the real risk on this. But you're in a scenario where you have 20 QPs, you have a president, CEO, vice president, all these people are on board, they're on a ship, we're going in one direction, we need to deliver. We committed to the investors that we're going to deliver in Q3. Let's find a way to go quicker and do a part of what you're requesting. And we see this in many aspects. This might seem like an extreme example, but it's a very, very interesting scenario. So following the Second World War, during the Nuremberg trials that were prosecuting the Nazi guards for the Auschwitz and the other concentration camps, following those trials, there was a lot of questioning, like how can humans be who these young German men who were in middle class society, were not sociopaths or psychopaths before they went into these prison guard situations. How can they do these horrible acts? And they said, well, let's run some controlled experiments. So here we have a guy off the street, and he's being instructed that he needs to provide an electric shock to this actor who's not actually being electrocuted every time he gets an answer wrong. And essentially you have another actor, which is the scientist, charismatic, tall man wearing a lab coat, who's requesting, please, every time there's an answer, and every time the test subject says, well, I don't feel comfortable, I don't want to electrocute this person, he would use simple language like, please continue, the experiment requires that you continue, you have no other choice, you must go on. And this is the scale of all the different levels of electrocution. And it goes through a scale of like, this could cause, you could kill this person. And the psychologists running this experiment were surprised, like, holy crap, like, it's fairly easy to force someone to get to this stage. And this is an extreme example, but if you can imagine in a mining scenario where you're just requesting that we change the assumptions to be more favorable, and you can use this type of language, you can have a president or CEO who's very charismatic, has lots of experience, has built mines before. It can affect the way that the consultant looks at the study and the different assumptions going into the study. The anchoring effect is an individual decisions, how the decisions are influenced by a particular reference point, regardless of whether it's valid. So we have a very specific example. This is one of the Red Lake gold deposits that failed. So in 2011, there was a resource estimation which resulted in 4 million ounces of resources estimated. We now know that estimation was not based in any form of reality. Later that year, a very reputable consulting firm reduced that resource estimate. In 2013, a separate, very reputable company estimated the resources and again reduced it. So it's not, between these two estimations, tens of kilometers of drilling was done, and the QP stood his ground and said, no, listen, like, I don't believe that the previous number was right. I'm reducing it. And I'm sure there was, a battle in the boardroom to say, like, how can you do this to us? We've done all this work and you're reducing what we have. And this project was actually built. $400 million were spent. And it went, after it failed, they realized the gold was not where they thought it was. They redid an estimation and came out with 400,000 ounces. So a tenth of what the initial estimation was. So if we take those two estimations and reverse them, if the first estimation had been 400,000 ounces, I'm quite certain that the next two, the middle two done by the consulting firms would have not been plus 3 million ounces. So that reference point, even now with hindsight, it's obvious, but that reference point of 4 million ounces was obviously in the mindset of the people doing those studies. The compromise effect is basically the tendency towards the middle option. So oftentimes we'll get the QP or the experts will provide an estimate of a cost or a metallurgical recovery or another technical aspect. The very experienced CEO or president comes back and he says, well, I have all these other examples where, you know, it's cheaper or it's better recovery. And then there's a discussion. There's a negotiation around the assumptions that are going to go into the studies. And far too often, there's some sort of compromise to go in the middle and find some sort of compromise because we're part of a team. We want the project to move forward. And we get a result that's somewhere in between. So if you have one or two of these things that occur, the impact is not that important. But we have dozens of assumptions that go into these studies. And the combination of these assumptions are not necessarily aggregating linearly. Some of them will aggregate in a very severe way. So if we take, for example, an open pit project, we have an aggressive capping, we have steeper walls in reality, and we can have a pit that gets bigger. So let's say the pit gets 40% bigger. We use Taylor's rule. We get a bigger processing plant that reduces the cost. We rerun the pit. We get an even bigger pit. So these things can run away fairly quickly, and that's just with two separate. And there's obviously dozens of assumptions that go into these studies. The survivorship bias is drawing conclusions from an incomplete data set because the data survives some sort of selection criteria. So this is a military plane from the Second World War again. There was an engineer who was tasked with figuring out where was the best place to place the armor on the plane, and he compiled all the data from the planes that came back, had gunshots through them, and he's like, oh, there's clearly a pattern here. Maybe we should put the armor where we have the bullet holes. But it's the opposite. With a little bit of thought, he's like, geez, every time that a bullet hole goes through the cockpit, the plane doesn't come back. I don't have the full data, and actually I should be reversing the data. And there's a few situations that we see in the mining industry that are like this. But for me, by far, and you know, I'm biased because this is my trade, is the resource overestimation, particularly for gold deposits. So drilling is expensive. We don't want to do it because it seems like it's not increasing cost, the certainty around that. And then we get to the stage of the geological model. And this is the step that's most important. We need to create solids which help define what's ore and what's waste and separate them to two separate populations. In certain cases, like Malartic or the Eagle deposit, most of the mineralization lives within a big potato-shaped object. The grade within that has variability, but it's mostly above cutoff grade, so the risk of those types of deposits is very low. In most scenarios, though, we have thin, discontinuous veins that are hosting the mineralization, and this is where the risk is. If we don't have enough drilling, we can't really define and create these airtight solids. So oftentimes we see projects that describe the complexity and say, oh, I'm just going to estimate within the big potato. The process of resource estimation is a process that generally makes averages. So if we take the raw data, we see there's a lot of zeros in this case, and there's a long tail of very, very anomalous values. When we go towards the block model, essentially we're forcing the values back towards the mean, and this deforms the distribution and creates more blocks than is deserved above the cutoff grade. So this goes back to the survivorship bias. All of a sudden we have all this material that shouldn't deserve to be surviving, and it's surviving this cutoff grade because of the impact of estimating within the big block. And because we violated this very first step of trying to separate ore from waste, and we're not really dealing with separate populations, then we get some gross, messy variograms. And there's a few buttons that you can easily press within the software, which gives you a nice variogram. And this is one example that was actually used for the classification of the example I gave before, with the range is 400 meters, whereas if the mineralization had continuity of 15, 25, 50 meters, it made no sense that should be used as a reference point for the classification. In terms of classification, this is we live within this space mostly. I invented this cognitive bias because I think it's very real for what we do. Essentially, the quantifiability bias, I would define it as we tend to use parameters or measures where it's more quantitative, and we will avoid parameters that are more soft or more qualitative. So presenting a variogram and telling the supervisor, this is the reason why I'm selecting this drill spacing, is a lot easier than saying, I feel uncomfortable with my uncertainty around the folding. It's hard to define a specific number for that, and we generally don't do it. So the orogenic gold deposits live in this space here of very high geometric grade unpredictability and geometric unpredictability. And on the geometric side, it's not just the shape of the ore solid, it's the size and shape of the above cutoff grade portion of that. And within the ore solids, and especially in precious metals, we often have scenarios where a small fraction or less than half of the blocks within the ore is actually economic. And that's rarely exercised in practice. The street light effect occurs when people only search for something where it's easiest to look. An example in geology, these are three separate, it's the same block model. It's a vertical gold deposit, and at three separate cutoff grades. I'm sure it's really hard to see, but they're at three cutoff grades, so 3 grams per ton, 4 grams per ton, 5 grams per ton, and the red is just basically above cutoff grade, gray is below cutoff grade. And you can see by applying an increasing cutoff grade that the deposit becomes more disjointed, it's sheared apart, and it's really hard to define. So in a lot of cases, we start with saying, well, this deposit needs to be 5 grams per ton to be economic, but I would not want to try to build stopes. You need to build rectangles within which the ore needs to fit on this 5 grams per ton. You can do it, and a lot of people end up doing something like that to get through the study. You know, I think in this case, it would be more interesting to ask the reverse: is this is what the deposit can easily deliver? What kind of economics can I build out of that scenario? And we should all be ready to accept the fact that this is not economic. I mean, all of the projects that we see in the technical reports, you never see a negative IRR. They always have 10 to 30 or 40% IRR, because we're sort of forcing them, we're dragging them into those values. The framing effect is presenting the same outcome as a loss, has a greater psychological effect than presenting it as a gain. So McDonald's was trying to sell us some low-fat burgers in the 80s. And instead of calling it a 9% fat burger, it's a lot easier to swallow when it's 91% fat-free. And the example in mining is trying to deliver an economic viability of a project, not by showing a single number. So in the technical reports, we see 1 NPV or 1 RRR. If you go to the back of the report, you'll find sensitivity analysis, but we're just varying single assumptions at a time. But in reality, we have enough data and knowledge to do a much more sophisticated variability evaluation of the NPV and plot them as a simulation like this. But presenting this to financing organizations is not palatable, because to show that there's a 20% chance that the project loses money, basically the conversation ends immediately. But in some cases, you know, as we saw, if a third of the projects are failing between 2010 and today, then some of those projects should not have been financed in the first place. So this might be a tool to get people to think about, like, what's the real risk around financing these projects. So again, as I started to say, these cognitive human factors are really hard to measure, which makes them really hard to solve for. We're going through a process now of renewing NA 43-101, and through the consultative process, you know, I was trying to think of, like, how do we solve for these things? It's really, really difficult. So I hopefully some of my ideas will get through, but it's very difficult. But on a personal scale, I think 3 things that we can do is, first, understand that we're not rational. If we understand these cognitive biases, then we're more likely to question ourselves and get to an answer which is more rational. Secondly, compare assumptions with operating mines. I know what the data looks like on the charts that Larry gave for the operating mines and the technical reports. They're quite a bit more conservative or robust. And slow down the step of selecting assumptions. A lot of these things are done very quickly. The metallurgical recovery is a short discussion. We get to that. Maybe it's established at the scoping level, and because of the framing bias or the anchor bias, that number sort of like lives through study by study and becomes the main final. So that's it. Thank you very much.